And Steve Keen on the line with us, professor of economics and finance at the University of Western Sydney, the author of Debunking Economics, his website, Debt Deflation, D-E-B-T, deflation.com. And when you go there, you go to the blog, and there you can find out about his Kickstarter campaign to raise some money to create this new monetary simulation program called Minsky, named after the famous economist. And so, Professor Keen, we were talking about the possibility that that if in America we've been running this trade deficit basically since I believe the 1970s. I may be wrong. I don't have I haven't looked carefully at the year by year numbers, but Nixon really got us started on this whole thing. Let's open up to China. Let's free trade stuff, and then the doors really got kicked open during the Clinton administration, and that one solution to our so-called deficit problem might be our trade deficit to reverse our trade deficit, turn it into a surplus. How does that current accounts piece interact with the two accounting pieces of the private economy and the public economy, as it were?
In a rather complicated way, because for a start, if you run a trade surplus, then what you're doing is you're selling American goods. And if people have got to convert their currencies into American dollars to get hold of your goods, so you are then, and you've then got to you might sell a good, say in France in francs, and then with that proceeds in francs to bring it back to the country, you've got to then sell those francs and buy American dollars to then put those in your accounts back in America. So you've got an exchange rate mechanism caught up in the middle of the whole thing as well. Mm-hmm. Plus also, when the country's running a deficit, then to finance that, it's effectively taking out loans or selling parts of its own capital stock as equity to the rest of the world, and you therefore get equity transfers, loan transfers, and then, of course, servicing flows. So it gets to be horrendously complicated, and I'm approaching this one step at a time with my Minsky software. So I'm starting with a capacity to model the entire globe, and then my way of looking at international trade is once you've got a complete capacity to model the entire system, then you break it in two, and you then say, okay, what are the relationships between these two entities or three entities or whatever, and then what you've got between them, of course, is international trade and capital flows.
Right. And I mean, going back to kind of Adam Smith and Wealth of Nations and the idea of, one country making cheese, one country making wool, and one country making wine, and therefore everybody benefits when they trade with each other. But if two of those countries are both making cheese, now you've got a problem. And if we had that deal with France, and France had to give dollars, first of all, it's going to drive up demand for dollars. But secondly, France may well get the asset base by exporting their wine to Switzerland, and so the Swiss end up on the short end of the stick, for example. And then they make watches and they sell them to the rest of the world. I mean, go ahead.
It gets immensely complicated, and I think that's one reason that, neoclassical economics tried to simplify the whole thing by a range of what they call simplifying assumptions, what I call outright fantasies, such as all economies in full employment at all times. You can easily transfer capital and labour from one sector to another, and exchange rates adjust instantaneously to handle any imbalances, so the actual current account deficit for every country on the planet is zero. All total nonsense. Yeah. But if you want to then take a look at the full complexity, then you run into all the issues you're talking about. And what you tend to find is that it's then dynamic processes that dominate rather than the efficiency gains that neoclassical theory talks about.
It's almost like trying to nail down the weather when, yes, it's all one globe, but there's a low pressure system here and a high pressure system here, and it's still the same number of moles or molecules. For a country that is looking to diminish its trade deficit, I know, it used to be tariffs were the name of the game that everybody was using around the world. The tariffs went away with so-called free trade to a large extent and have been replaced with value-added taxes, VAT taxes, where you can reverse that tax out on export or you can double that tax on import, and they serve as effective tariffs. Germany's very good at this. Japan's very good at this. China's starting to do it. are there other ways to do it? And first of all, is my analysis of that accurate? And secondly, what in your opinion would be the best way for the United States to go from an $800 billion a year trade deficit to at least zero, and ideally to a trade surplus?
Well, I mean, America's real problem comes down to the fact that it has to import large amounts of oil. Well, pardon me, Tom, I didn't turn my mobile phone off.
That's quite all right. That's quite all right.
Do that. I've got a busy day today.
Yeah, that's fine, Professor. Just crush that phone with your heel. We're talking with Professor Steve Keen.
I'll just hang off on it. Okay.
Yeah.
I think the main way the countries try to do it these days is rather like South Korea's done with industrial policies. So it has we say it wants to build a Tier 1 network throughout the entire country, which it actually has done. So every South Korean house has an internet cable that's the same as I have at my university, plugged in, rather than relying upon ADSL and wonky things like that.
Well, that's infrastructure.
And infrastructure building, and they specify that every last house had to have it, and therefore they didn't care how the private sector did it. They simply had to make sure that everybody had that facility built in, and of course. That was something which with South Korean companies building the cable infrastructure got the inside running on, and then having done that, consequently they developed the technical capacity necessary to do that and export that to the rest of the world.
Well, that was one of Hamilton's suggestions. Hamilton's 11-point plan included subsidizing domestic industries and encouraging industries that would innovate.
The other thing, though, you've got to be careful about that, because Australia's made a classic set of mistakes on the same front. We did that without specifying that it had to be local capital. We looked at what's happened in South Korea and happened in China. They always specified, even if they did export-oriented industrialization, where they teamed up with an American company, let's say, to produce things like what all became Foxconn, the rules were such that they had to have a Chinese partner, and within about 7 years, the Chinese partner had to own 49% of the business.
Right.
Now, I think I'm making 51%.
Otherwise, you're toast. Steve, we're out of time, but thank you so much for being with us today. Hang on just a second.
You're listening to the Thom Hartmann Program. Call 866-987-THOM.
Professor Steve Keen, get over to his website, debtdeflation.com, and kick something into the Kickstarter Minsky program. Thank you, Professor.